Home price appreciation continues to balloon at unforeseen levels, and mortgage rates continue to soar. Millions of homeowners out there are waking up to the fact that their monthly housing payments are getting significantly more expensive. At the same time, millions of potential buyers are getting entirely priced out of the market, which is leaving economists, real estate experts, and policymakers increasingly worried about an impending housing market crash. In fact, last week, the Federal Reserve Bank of Dallas reported many signs indicating a brewing U.S. housing bubble. Researchers concluded that as affordability worsens and impacts people's purchasing power, home prices are set to collapse as they finally readjust to our economic reality. Now, we have a lot to discuss today, so before moving on, please don't forget to leave a thumbs up and subscribe so you don't miss our future videos. The United States housing market has heated to a boiling point over the past few years, but for most of that time, real estate experts insisted that the market wasn't in a bubble. The Federal Reserve had artificially suppressed mortgage rates, keeping them in the unprecedented mid-2% range, which allowed many of those experts to argue buyers could afford the inflated prices. And as opposed to what happened in the 2007-2008 pre-crash period, today we have a housing shortage that has actually reached crisis proportions and resulted in many more buyers than properties for sale. So, given the current conditions, this market could support the frenzy. So they believed. Well, now that mortgage rates have surged to their highest point in more than a decade, all of those experts don't seem so sure about that anymore. Many of them are actually warning that the housing market is in a massive bubble right now and that conditions are deteriorating fairly quickly. There's only so much that potential home buyers can afford before they're priced out of the market. Last month, when rates went above the 4% mark, the number of buyers applying for mortgages dropped considerably. Home prices have already jumped by a staggering 19.2% nationally. In some markets, that increase was well above the 30% mark, and according to new estimates released by the National Association of Realtors in March alone, at least 9 million more buyers were priced out of the market. The breathtaking pace of home price appreciation has started to raise fears that a real estate bubble could be setting the stage for another burst, which led economists with the Federal Reserve Bank of Dallas to publish a note warning about the consequences of the growing U.S. housing bubble, and explain that even though today's fundamentals are different than the ones that led to the previous bubble, the risks are still very real. The researchers noted that this bubble has been forming since 2012, and the acceleration in the pace of home price appreciation began before the health crisis, but has strengthened noticeably since early 2020. For prospective buyers and sellers, as well as policymakers, knowing the state of housing markets is imperative, they wrote. Using a novel statistical toolkit for assessing the health of the U.S. housing market in real time, we argue that the underlying causes of the run-up differ from those during the last housing boom, which preceded the 2007 to 2009 global financial crisis. However, there is growing concern that U.S. house prices are again becoming unhinged from fundamentals, the economists continued. An asset, in this case housing, is in the primary expansionary phase of a bubble when price rises are out of step with market fundamentals. Real house prices can diverge from market fundamentals when there is a widespread belief that today's robust price increases will continue. The Fed analyst wrote, referring to the buyer mania that is leading some to believe that this bubble will go on forever. If many buyers share this belief, purchases arising from a fear of missing out can drive up prices and heighten expectations of strong house price gains, they added. explaining that this is a self-fulfilling mechanism that pushes price growth to become exponential or explosive, consequently resulting in a housing market completely misaligned from fundamentals, making investors become cautious, policymakers intervene, and causing the flow of money into housing to dry up, which then triggers a housing correction or even a bubble bust. Expectations-driven explosive appreciation, often called exuberance, in real house prices has many consequences, including the misallocation of economic resources, distorted investment patterns, individual bankruptcies, and broad macroeconomic effects on growth and employment, the Fed report highlighted. The economists urged policymakers to respond before misalignments become so severe that subsequent corrections produce economic upheaval. They also pointed out that many indicators show that today's market is being driven by speculation. The first phase is nonlinear when graphed because it is explosive during the boom or exuberant stage. The second phase often results in a price correction or even a collapse if the market crashes, the researchers concluded. So yes, although this isn't the 2008 subprime crisis, the market is indeed experiencing a dramatic structural shift, with consequences that most buyers won't grasp until it's too late. The prospect of a real estate bubble burst sparks fears in anyone who remembers or felt the impacts of the previous housing market crash that plunged us into the financial crisis and subsequent Great Recession. As market conditions remain volatile, Americans are feeling increasingly pessimistic about the future of their own housing options. A recent article shared by The Hill showed that more and more Americans are losing confidence that they will ever own a home. A new survey by the Federal Reserve in New York uncovered that only 43.4% of renters believe they'll ever own a home, the first reading below 50% in the survey's history. Compared with last February, the drop amounted to a decline of 10 percentage points. The survey described that housing affordability has been crashing by the most on record, as the massive increase in prices over the last 2 years has left first-time buyers at a tremendous disadvantage. Renters also said that they expect rent price hikes of 11.5% over the next 12 months, compared with just 6.6% in February 2021. That echoes the results of a separate report from Realtor.com, which found rent prices have skyrocketed this year, following a significant dip in 2020 and 2021. It reported that median rent in the 50 largest metros reached a new high of $1,792, and that is a 17% jump from 2021 levels. To make things worse, a recent hike in mortgage rates doesn't help at all. Last week, the interest rate for a 30-year fixed-rate mortgage hit a 10-year high of 5%. As Americans contend with historically high inflation, the combination of rising mortgage rates, elevated home prices, and tight inventory are making the pursuit of home ownership the most expensive in a generation, stressed Sam Cater, mortgage administrator, Freddie Mac's chief economist. In recent weeks, mortgage demand has continued to crumble. The total application volume declined 5% last week alone and was almost half of what it was a year ago, according to the Mortgage Bankers Association's seasonally adjusted index. In a housing market facing affordability challenges and low inventory, higher rates are causing a pullback or delay in home purchase demand as well. Home purchase activity has been volatile in recent weeks and has yet to see the typical pickup for this time of the year, explained Joel Kahn, MBA's Associate Vice President of Economic and Industry Forecasting. The latest increase in rates means that buyers all around the nation are paying nearly 42% more in their monthly mortgage payments for the same house today than they did a year ago. The combination of rising home prices and escalating mortgage rates has added hundreds, and in some cases, thousands of dollars a month to those mortgage bills. And that's coming on top of what all those potential buyers are spending on everything else. With inflation running at 8.5% and gas prices soaring 40%, millions of people out there are completely tapped out. Adding even more distress to the outlook, this week home buyers just got another gloomy statistic. Average home prices in 11 real estate markets now exceed $500,000. In San Francisco, the median home price right now is actually $1.3 million. That's the median home price, and that's an overwhelming sum for the vast majority of the population. So, how can the system handle skyrocketing home prices, mortgage rates, and rental prices simultaneously? The simple answer is that it cannot. Buyers are starting to realize just how much these higher mortgage rates will eat into their budgets, so they're making lower offers or dropping out of the market entirely. According to an analysis conducted by Black Knight, the typical American household would now have to spend 31% of their monthly income to make a mortgage payment on the average priced U.S. home. That's up from 29% just 1 week earlier, and it marks a 24% increase from December levels. In fact, in the final quarter of 2021, the average 30-year fixed mortgage rate was 3.11%. So, at a 3.11% rate, a borrower would owe $1,710 per month on a $400,000 mortgage. However, if a borrower got that loan at a 5% rate, that payment would spike to $2,147. That's a bigger deal than it might first appear, because in total, that would add up to an additional $157,337 over the course of the 30-year mortgage. This is not what a healthy market looks like. For Desmond Lackman, a senior fellow at the American Enterprise Institute, housing is in a financial bubble that includes stocks and bonds. And even though it remains to be seen if home prices will fall out right now, or somewhere at least in the near term, he, quote, wouldn't be surprised, unquote, if housing prices start to unwind this year. Considering the many supply and demand imbalances, the growing inequality gap in net household wealth, and worsening work conditions in today's labor market, most buyers don't have enough cushion to stay afloat when the real estate market breaks. With wages failing to keep pace with the rise in house prices and mortgage rates, a meaningful decline cannot be ruled out. And even if those who swore up and down that there was nothing wrong going on in the market over the past 2 years are now admitting that there are serious risks of a bubble burst, and we should start bracing for another disaster in the months ahead.